The reality is that 90% of a stock price's growth happens long before the IPO. And that's where pre-IPO investing comes in. In case you aren't familiar, a pre-IPO company is a private company that hasn't gone public through an initial public offering, direct listing, or SPAC merger yet. Think Amazon in the 90s before its IPO, or Tesla in the early 2000s. These insanely valuable companies today were once private companies with pre-IPO stock worth next to nothing. And because pre-IPO stock is worth so little in the early days of a company, it doesn't take much increase in dollar value of the share price in order to see huge percentage increases in gains. Think about it. Going from 10 cents to $10 is practically a $10 increase in share price, but equates to a 10,000% gain. On the other hand, going from $10 to $20 is still a 10% increase in share price, but only a 100% gain. That's 100-fold less growth than that initial $10 growth in share price. You can double your money every 10 years by investing in an S&P 500 index fund. Or maybe even 10x your money investing in a single stock. But where else besides investing in pre-IPO companies can you 100x, 1000x, or even 10,000x your investment over the same period of time? Altcoins? Options? Okay, yeah, but you get my point. The potential multiples you can make on an investment in pre-IPO companies are staggering. I mean, that's the reason why finance YouTubers like Graham Stephan and Andre Jick have expanded into private capital in pursuit of massive gains by investing in pre-IPO companies that they believe in. So that's enough hype. Now, let's get into the downsides. Investing in pre-IPO companies comes with a number of risks. The biggest disadvantage we have as retail investors when it comes to pre-IPO investing is that it's impossible to determine the fair market value of pre-IPO shares because we really have no idea what's going on at a private company since they aren't required to disclose any information about financials, risks to the business, or future revenue guidance to the general public. So unless you're an insider, you're really just shooting in the dark when it comes to valuing pre-IPO stock. I mean, pre-IPO shares of Coinbase were trading for over $300 leading up to its direct public listing, but shares were trading for as low as $208 quickly following the IPO. Another risk is that there are no guarantees that the private company you invested in will ever go IPO. In fact, it's likely that you'll end up writing off your investment since most private companies never reach a successful exit. It's also important to note that pre-IPO stock is considered illiquid, meaning that you cannot easily sell your shares. It's not like you can just swipe up on Robinhood and get access to cash instantly. You might as well forget about whatever money you invested in a pre-IPO company because that money is essentially going to be held hostage until some sort of liquidity event like an IPO or acquisition. Also, if you're an early investor in a pre-IPO company, it's likely that your stake will be diluted with additional rounds of funding. The amount of dilution usually falls between 20 and 35% per round, but it really depends on whether or not a company is in a strong position during fundraising. Ideally, the valuation of the company is going up with each round of fundraising so that you don't feel the effects of the dilution too much. But I've also seen the valuation go sideways, or worst case, a down round will send your stake in the company to the gutter. Another risk that many people forget is that if you buy pre-IPO shares, you will most likely be subject to the insider lockup period for employees and pre-IPO investors. That means that you won't be able to sell your shares for at least 3 to 6 months after the IPO. You won't be able to take advantage of any initial pop right after the IPO, and it's possible that the share price could tank leading up to the lockup expiration as other investors anticipate a flood of shares on the market from pre-IPO investors and employees. If you want to find out how to profit from the end of a lockup period, then make sure to subscribe and check out my previous video that explains the process. So, if after hearing all these risks, you still want to invest in pre-IPO companies, what ways are there for you to buy pre-IPO shares? I've been on both sides of pre-IPO trading as a buyer and a seller, and I'm not gonna lie, unless you're an employee, venture capitalist, or angel investor, it's gonna be tough. I mean, there's always secondary marketplaces like Equityzen and Forge that I've mentioned in previous videos, but they only offer trading of late-stage pre-IPO companies, meaning that the private companies offered on these marketplaces have already received multiple rounds of funding from venture capitalists and have already seen the majority of their growth in share price, and the expectation of an upcoming IPO is likely inflating the share price anyways. Not to mention Forge, Sharespost, Equityzen, Microventures, and all the other secondary marketplaces usually have pretty strict income and net worth requirements for accredited investors on their platform, which prevents most retail investors from even being able to buy pre-IPO shares on the platform. Another option to get in earlier on the growth curve is to invest directly in a private company as part of a funding round. But here's the thing. The chances of you having access to such an investment are extremely low. Usually, any early stage pre-IPO company with high growth potential that's raising money is already fully subscribed by venture capitalists. In fact, I would be wary of any private company that needs outside funding from retail investors, because that means that all of the venture firms have already passed on them after completing their due diligence. I guess you could indirectly invest in pre-IPO companies by investing in a highly respected venture capital firm or some fund that aggregates pre-IPO companies, but your potential gains will be limited because of the vast number of private companies that don't ever produce returns for the firms. So, finally, should you invest in pre-IPO companies? My short answer for most of you is no. I would say that unless you have access to a seed round as an angel investor or as a friend or family member of the company founders, then I would steer clear of investing in pre-IPO companies, because as outsiders, we simply don't know all of the relevant information in order to make an informed financial decision. And realize that for every Tesla or Airbnb, there are tens, if not hundreds, of pre-IPO companies that will end up costing you big time. If you do decide to invest in a pre-IPO company, take a very close look at the founding team. What is their track record, and do they still hold essential roles in the company? You ideally want to see a founding team with a history of success. So with all that said, remember, I'm not a financial advisor. Investing in IPOs is risky enough, but investing in pre-IPO companies can be even riskier. So learn as much as you can before deciding whether or not all of this is right for your goals and risk tolerance. For those of you that made it to the end of the video, thanks. I really appreciate it. I'll see you guys in the next one.